trading stuff. This video will blow your mind.
Another awesome video. So today we're going to be talking about this. Not a lot of people are. Let's go over it. There's two types of people when it comes to talking about what this is. There's one group of people that says, this is a store of value. This is something that has value. It has value because other people think it has value. And there's another group of people that think that, it's worthless, and that it's not backed by anything like a commodity like gold or silver. And so it has no intrinsic value, and so therefore it is useless. And kind of just to go off of like what we're actually looking at right here, this piece of cotton and linen is what these are actually made out of. It says on the bill right here, if you read it, it says right here, this is legal tender for all debts, public.
Alright, so let's take a look at that really quick just because the video is a little bit blurry. So when you go to Fed Notes, jeez, this is being slow. Okay, right here. It says Federal Reserve Notes. So the first thing is when people start talking to me about fiat currency, the first thing that goes into my head is every time people say dollars, it's not been called the United States dollar for the longest time. It clearly says right on the top of the bill right here that this is a Federal Reserve Note. So the second somebody starts saying it, talking about dollars or money, they just don't know what they're talking about is the first thing that I think. And then this is the next part that I'm going to be talking about. This is a note, legal tender for all debts, public and private. Okay, and that's, again, this is a Federal Reserve note. It's not a dollar. And then this is a note, what we say is paper note, but it's actually made out of cotton and linen, if you want to get technical. And then it's legal tender for all debts and public and private. That's going to be extremely important when we figure out what exactly we're looking at here.
And private. So let's go over really what this means right here. So this is a note. It's a Federal Reserve note. That's what we need to call it. So you see the federal right here, and then you see the note says right there. So what we're looking at here is a Federal Reserve note. Dollar bill is the old term that we as in society, culture, keep around, but it's really the Federal Reserve note. And this dollar is not really a dollar bill. A dollar bill used to be, $1 bill used to be a piece of paper that was backed by one unit of gold, like equivalent in the dollar amount. But we're working with Federal Reserve notes. Obviously, I think you guys know that the Fed prints these, and it is...
Okay, so I want to stop right there. So that's actually a common misconception that the Federal Reserve prints money. That's society's perception, and this is one of the most basic videos I'm going to show you in finances. So this is just an introductory video. The Fed does not print money. The Fed actually doesn't even have the power to print money. Congress is the only person that had the ability to create money, and they got that power taken away in 1913 from the Federal Reserve, who doesn't have checks and balances. We're not going to get into all of that in this video. What I will tell you is that the Fed, whenever you hear, oh, money printing, this and that, that's not actually what happens. What happens is there's something called government bonds, and these bonds are printed. They're called IOUs, and the way that I think about them is like I owe you money. They're called IOU. Those are all letters. And then what they do is they borrow money from the Americans in the form of bonds, and then they put those in their liability column. They owed the Americans the money, and then they purchase assets with, and that's how the Federal Reserve sets up their what's called a balance sheet. But that's just a little technical. That just kind of bugged me right there. Let's get back into the video.
We'll talk about it more, like what exactly it is. It's a credit system. So this is legal tender. So what makes this valuable is not the fact that, people think it has intrinsic value. That's wrong. The thing that makes it valuable is that the government is willing to back this currency up. So it says right here, this note is legal tender. So that's the first part, that the government is willing to back this up, and you can pay your taxes in these Fed notes. You can, if you go into a courtroom and somebody like is suing you and you owe them a debt, you can pay in these Fed notes. This is what gives it value, but it doesn't have any intrinsic value like somebody might point out. So it's not necessarily that one's right or the other. They both are kind of right, but they're both not on the money.
Okay, that was like a dad joke. They're not on the money because it's money. It's a joke. But yeah, they're both wrong. It's not necessarily that it has intrinsic value. It doesn't, but it's not entirely worthless because the government is willing to back it up. And as common sense as it sounds right here, as I'm pointing it out, it's not common knowledge.
Let's go over the second part. This is legal tender for all debts, public and private. So all debts, public and private. So really what this is, if we're saying that this is paying off debts, is that this is a credit system. So what you're doing is you're crediting the debt. So this is really, a credit. This is $1 worth of credit to pay off $1 in equivalent of.
So why am I saying this? The importance of this is really once you start learning, this video is probably going to be 3 to 5 hours of the most mind-shattering content ever. They don't teach you this stuff in school purposely. It's like, who was it? Henry Ford, the guy that made the automobile, one of the most important people on the planet. Throughout the entire history of mankind. He said, if people knew about the banking system, then they wouldn't put up with it and there would be riots in the streets tomorrow. They don't teach you this stuff on purpose. I'm teaching you this stuff on my YouTube channel. This is going to be the most underrated channel. But the reason that I'm teaching you this is because you need to understand how finances work, but you need to entirely switch your perspective on how you think about money. It's not even currency. The United States dollar is not even currency. It's literally money, and it's a horrible form of money. And we're not going to get into that on this video, but when you think about money, and I'm going to go into it in a second, but when you think about money, you don't want to think about it as you're storing value, because that's just wrong, like I pointed out earlier. The other thing is you don't want to think about it in terms of anything other than a credit system versus a debt system. That's a really weird position. You don't want to think about it as anything but a credit system and a debt system, because if you think about it as anything more, you're giving these paper notes more power than what they deserve. And I'm gonna let this clip play out, and then I'm gonna show you exactly what I mean when I finish this video and start talking.
And the Fed knows this when they print them on their balance sheet. So, when they print these on their balance sheet, they have the asset and the liability column. And just like any accountant would do, you have, something that you take out in debt. So like, let's say you have a mortgage or something like that, then you.
Okay, so this is the part that I'm going to finish with. So when you go to get a loan, because this is extremely important, every single major company on the planet borrows money, and we'll get into that later. But it's an incredible. You cannot be good at finances if you don't understand the debt system and how to leverage it. So basically, what the point is of this is that this is a credit. A dollar bill is a credit. If you have $1 bill, it's $1 bill worth of credit to pay off $1 worth of debt. And when you go to the bank, you're looking for what do they ask you for? Do they ask you for dollars? No, they ask you for credibility. Why? Because you're getting credit. You need credibility to acquire more credit. And when you have more credit, what does that give you? More credibility. Okay, nobody explained it to you like that on purpose, because they don't want you to really understand the system. They just want you to go along with it. But it's extremely important. So we're going to go into this video next. We can't go into that one. That's way too advanced. Let's see. What are we going to be looking at next? Let's talk about good debt for a second. This is extremely basic finances. So knowing enough about a subject to think that you're right. So just the first sentence. A lot of people don't understand finances whatsoever. And when you talk about debt, they think that all debt is bad. And I'm going to explain to you how you would go about, allocating debt into large positions. And actually, right now is the best time to be allocating debt. And this is how people don't understand how people become 100 millionaires, billionaires. It's a part of it. There's a lot. They leverage humans. They also leverage debt. Those are the two big things. But let's continue on with this. But so knowing enough about a subject to think you're right, but not knowing enough to know you're wrong. This is the story of my life. I see it so much in crypto. I see it so much in real estate. I see it so much in finance. So in finance, debt and credit-based system, we just kind of covered that a little bit. Most people think all debt is bad, and conspiracy theories and gold standard worshippers. So this is what this means. We have the gold standard, and there's pros and cons to the gold standards, and there's pros and cons to the credit-based, debt-based system. And there are very few people that are willing to acknowledge, let alone understand either one of these viewpoints. But so essentially you have two types of people, mainstream people. You have the people that are like, oh, debt's bad, and like then you even have the conspiracy theorists that are like, oh, the Federal Reserve's the most evil thing ever. And these guys tend to favor the gold standard. And so it's actually very toxic. And regardless of what you think about the Fed, it's here to stay. And the $1 trillion stimulus package is kind of, if the spoiler alert, if they don't print money or lower interest rates, the entire economy will literally collapse. I mean, it'll collapse, and then the entire system will get destroyed if the bond market, if it costs too much money to take out bonds, and the rates aren't at a premium that incentivizes people to loan their money out. But we're not going to get into that. That's extremely advanced economics. This is gold standard. Worshippers think that banks are pure evil designed to enslave the world with inflation. That's toxic thinking. There's actually pros and cons to the debt-based, credit-based system. And one of the major pros is that it's actually deflationary towards debt, or inflationary towards debt. And so when you have something like a real estate property, you credit, like, let's just say a massive mortgage of $400,000. Well, that $400,000 stays the same $400,000 that you owe the entire time, and as inflation continues to get higher and higher and higher, it's easier to pay off that money because it stays the same. And it basically cancels out the interest rate. And as we're going to see in the coming years, when inflation gets really bad, and there's a lot of reasons for this. And right now they're doing things like what's called QE and QT, which is quantitative easing, which is what the normies call money printing, which is not even close to correct. And then QT, which is called quantitative easing. Again, that's extremely advanced economics to manipulate the DXY, which is a basket of currencies. We're not going to get into like the extreme advanced economics. But my point is this: there's people out there that think that banks are pure evil designed to enslave the world with inflation. There's a massive amount of most of the smartest people in finance that think this. But that's not true. It is true, but it's not true at the same time. There's pros and cons to it. So like I said, one of the pros is that, like, when you have debt, the inflation you can actually leverage debt to make money, and you see that with things like mortgages, and then you also see that with things like assets and leveraging assets. We're not going to get into that right now. That's a little bit later. But these ideas are not 100% accurate. So I kind of went over that a little bit. And then debt is used by every major business as a tool to grow. So while every major business it uses this as a tool to grow, it's not a one-stop shop where you just borrow all the money you need. What you do is, when you need to expand your business, you borrow money. And we'll get into the numbers. And a lot of people are absolutely mortified of interest rates, and it scares them, so they stay away from debt. And let me tell you, you do not want to pull a Dave Ramsey. You'll never expand your wealth. And like in this current time, with this current age, when money is dirt cheap and inflation is going parabolic, especially with there's a massive, what's called in trading, there's a massive on the weekly chart, there's a massive head and shoulders playing out on the DXY. We could easily see the dollar drop 70% just looking at the charts from a distance. That's just massive. So you have to understand this stuff if you want to be even decent at finances. There's no excuses. This video is 100% mandatory. So let me explain how it works. Every company has a business model. If a business model is very profitable, they look to expand, possibly getting more employees, more marketing, or more product, just depending on the business. And then most companies already have most of their money tied down, and this is where debt comes in. A company will borrow money to make more money. Simplifying this idea, let's say, and then I go in through an example. You can read this if you really care, but basically, when you have a profitable business or when you have a profitable asset or just different things, and if you don't know what an asset is, we'll cover it later, but when you have these profitable things, the interest rates just get absolutely destroyed. Like, you make so much money. In this example, you make 98% on your money. If you care to read this little example that I wrote. But there's two reasons the middle class do not understand this principle. The first is because, like I said before, they're afraid of interest rates, and this is going to be absolutely catastrophic with all the inflation and everything, because just from a technical standpoint on economics, they just took us off the fractional reserve lending system to a no reserve lending system, and they obviously have more interest, or they have more stimulus packages coming up, and I'm not going to get into it very much right now, but if you think inflation is a problem right now, it hasn't even been factored into the system, and we're already printed 20% of the entire currency supply. So this year alone, we're already up 20% of the entire inflation. The currency has increased 20% in this year alone, and we're just getting started. So like I said, if you don't understand these things, you need to. This is mandatory. If you don't, it will be catastrophic to your financial situation. This would be a valid point. If growth potential investments is small, then yes, it would be high risk. Yeah, so basically what I'm saying right here is that you don't want to just always borrow money. So yes, people have a point that if there's a speculative investment, if just certain things, yes, it's not always good to borrow money. There's good debt and there's bad debt, and it comes down to when it comes down to, like, if people ask me, should I borrow money, should I not borrow money, how do I borrow money, like blah blah blah. It comes down to running the numbers, and it's risk to reward ratio, and you need to look at the interest rate, you need to look at the asset, you need to look at the potential, you need to run the numbers. So yes, sometimes there's high risk investments, assets, expansion projects, whatever the money is borrowing, and really what it comes down to, and the middle class has a really hard understanding of this, and so let me just break it down really simply. If you're borrowing money on something like a liability, very simply put, and we'll get into a liability a little bit later, but essentially what a liability is something that loses you money. So technically, if you talk to an accountant, they're going to say that a car is a liability, but if you borrow money with a car, you're going to be losing money at a more exponential rate. And then borrowing money on an asset is something that makes you money, essentially, basically. We'll go into more depth on these later, but I'm just trying to get you the absolute bare minimum, because we're about to go into some extreme concepts, like extremely advanced concepts, and I need you guys to be up to speed for your safety. So yeah, basically, like in short, you want to get undervalued assets and leverage them. So that would be like stocks, real estate, crypto. You guys have seen me on the channel on different social media platforms. I think I'm up 140,000 traded in profits. Most of that was borrowed money. So that was leverage. I couldn't have done that without borrowing the money. and obviously that made me a massive amount of money that I didn't have. So that's just one example of leverage. We'll get into real estate, we'll get into other stuff, but that's just something you can check out on the channel. Real world use case. And then like liabilities would be like leveraging, like, you know, you're borrowing a bunch of money maybe on a credit card or whatever to buy things like food. That's technically a liability, and that's obviously not good. So when it comes to good debt and bad debt, it comes down to a lot of things, but very, very simply, assets versus liabilities, and then you want to get a good deal on an asset. If you want to make it extremely simplified, we'll go into more detail. The other problem people have with borrowing money is a black and white outlook. In psychology, we call this cognitive miser. So cognitive, the brain, and then miser, you know, basically just being lazy. Like, so the brain actually has, yeah, and it says it right here, the brain's natural desire to conserve brain power of oversimplifying reality. So this is, you know, I took a lot of psychology classes in college, and essentially the understanding from a psychologist standpoint is, you know, people are always biased. People are always oversimplifying their reality to, like it says right here, conserve brain power, and that's a natural process of the brain. And basically people just simplify their reality and think they know everything and say, oh, all debt is bad, when that's very far from the truth. And actually finances needs to be looking at on a case-to-case basis, and there's actually no black and white in finances whatsoever. And it's not you should ever just buy a house. It's not ever you have to run the numbers, and that's very advanced, and we'll get into it. Here's the truth: debt increases a borrower's buying power. So this is absolutely monumental. I honestly do recommend that you take notes, because this is going to be the most important financial video you ever watch this year. I promise you. So I'm going to repeat that again, and I do recommend you take notes. Here is the truth: debt increases a borrower's buying power. So essentially, you know, if you have a really good undervalued property and you can't afford it, you can borrow the money, and this increases your buying power. And then if the property goes up massively, then you make a lot of money, because you own that property and you make whatever that property is going up, even though you just put the down payment on it. On the same token, it increases your buying power. So if you buy a property that's really crappy, then you're going to get absolutely wrecked, and your property is going to do what's called going underwater. Your investment's going to go underwater, where essentially you lose a lot of money. But the very simplified version of this good debt, bad debt thing is that debt increases a borrower's buying power. That's really what you need to know. This means if you buy something like a car that depreciates, you're borrowing money, meaning you get more money to get that asset liability. Depends on who you ask, and that's going to end up losing you more money. An example of this is an example of good debt is buying an undervalued house, like we talked about. Let's see, as the price of the house, so does the initial deposit. The difference between these are asset and liability. There are exceptions, but in general, yeah, so nothing's really bad, black and white. Okay, so that's good debt. I'm going to close that one out. Assets will make you rich, and liabilities. Let's take a look at this one. Assets will make you rich, and liabilities will make you poor. None of us choose to be on the debt-based currency system, the debt-based, credit-based currency system, but we are. And I couldn't have said it any better. I actually wrote this, but yeah, I couldn't have said it any better. And now with an unreal amount of new money being pumped in through our private banking system. So yeah, I just want to touch on this for a quick second. So the Federal Reserve is not federal. It's actually a private bank that was created through the system, and it's mostly ran through it's ran through the heads of the chair of the Fed, and there's multiple different locations. There's 12 different. I'm not going to get into like that part, but what this means is that when you think about Federal Reserve, you think of it like a private, or you think of it like a government entity, like, you know, the president or whatever, where it's the government, but it's a private banking system. And then so it's It's not federal. The name says federal. It's not federal. It's literally lying in the name. And then it says reserve. And the Federal Reserve actually doesn't have any reserves. So when you hear the word Federal Reserve, you think of a government entity that has reserves that's lending out money. And that's not the case. And I feel like a few people figured that out this year because there's been so much talk on the Fed. But if you didn't know that, the Federal Reserve doesn't have reserves. It takes IOUs from its citizens. All right, the US dollar is a horrible long-term investment. Everybody knows this. If you didn't know that, now you do. Go look at the DXY. It's down like 93%, 96% in the last however many years. Every single asset's outperformed it. The question is, where do we put our money? What is the best investment as a hedge against inflation in an asset that is reliable, long-term growth potential? Stocks are anti-inflationary assets, and basically what that means in the short term is that when you're buying a stock, you're buying a portion of a company. You guys know that, but when the government keeps printing money, they can print all the money they want. You know this. But you can't print more people. You can't print more Apple products. You can't print more profit margins. You can't print, you can't print another Apple. You can't print 3 more Apples. And so the price of the asset, the underlying asset, goes up because the asset stays the same and there's more currency to buy it. So, asset inflation, I talked about this a few years ago and wrote a few papers on it. This was actually one of the papers I wrote on it. It's just now getting published. But so yeah, stocks are anti-inflationary assets. As the economy worsens, essential businesses are going to be safe stocks, with big established businesses being the safest. I wrote this a long time ago. This should have got published a while ago because, we obviously now know this with like Apple and Amazon and Google. It's just absolute facts. So anyways, stocks are divided into 3 types. You have income, value, and growth stocks. So income stocks, also called dividend stocks, they pay out a percentage of their earnings. Value stocks are stocks that are potentially undervalued, and what we say in the stock market, because I was heavily involved with the stock market and had insane returns at one point. What we say about value stocks is basically the stock market is always factored in. Like, you're never really going to get a deal in the stock market. Everything is priced in how it's supposed to be priced. So when you're looking at value stocks, you really have to look at the stock and see something that the whole general market isn't seeing. That's why we always say that nothing's really undervalued as a finance or an investor, whatever you want to say. We always say that we're either bullish on an asset or we're not bullish on an asset because of 2 things. One thing being that nothing is guaranteed, and the other thing being that the asset is valued based off of the market. So being bullish on something basically means that you have a reason to think that it would go up, and you're basically placing a theory. And I don't want to say bet because it's an educated decision. Like, for example, the fact that there's a lot of development with EV cars and EV network with the current administration. So you could say that you would be bullish on the energy sector, and because you have that idea, you would essentially see something that's priced a little bit lower than what you think it's worth, and that would be considered a value stock. And then you have growth stocks like Amazon, Apple. These are just companies that are doing incredibly well, and they are going to continue to do incredibly well. So I pretty much went over all this, and then although as times get worse, what if companies do not pay out dividend? One of the best ways to see which companies are going to pay out dividends is their increased dividend. So this is what I'm saying right here. So so if the economy does really bad and a company is struggling, what's there to say that a company is going to pay out a dividend? So to negate this idea, because if a company is struggling, and believe it or not, because there's so many different shares of a company, a lot of these companies, especially the ones that pay out bigger dividends, they're paying out a huge percentage of their profit margins. And as the economy gets worse and the company potentially is going under, it's like they don't want you almost wouldn't want them to pay out their dividends. And then, or even if you do, like, are they going to? Because they might not have the revenue to cover those dividends. And so, what can we think about to negate that idea? And there's something called dividend aristocrats. And dividend aristocrats are basically a list of companies that throughout the time have stood this test of time. They're very high level companies. These are companies on the top 500 S&P, and they have a very good track record. I wrote down a lot of the different requirements. Basically, they have to have a minimum market capitalization of at least $3 billion, and these are basically the blue chippers of the blue chippers, basically to show over time that they're going to consecutively pay out their dividends. They're called dividend aristocrats. And then basically I said AT&T is a dividend aristocrat. It pays out a dividend. It's undervalued. And because of 5G being so massive, it's also a growth stock. So it's a growth stock, an income stock, and a value stock. And this is just kind of an example of an asset and getting a good appraised value of an asset. So that's really what that is just an example of how you would acquire a real asset. This one's crazy. I hope this blows your mind, so you got to pay attention. So if we simplify the $1 trillion stimulus package to $1, so why would we do this? This is just so you could understand it. Let's just simplify it to $1. So let's just pretend that instead of $1 trillion, let's just simplify it fractionally to $1. And if you were to put $1 into the banking system, it would turn into $9 because of how much money they can lend out on a fractional reserve system. Well, actually, this is outdated this is actually outdated information from actually when I wrote this financial paper. It's actually a no reserve system. So actually this $1 trillion stimulus package, anybody can take their stimulus check and they can take their stimulus check to the bank and they can go buy a car. And the bank can lend them out, if they put in $1,000, the bank can lend them out, if they want to, 10,000, 30,000, whatever the bank's comfortable with lending out, they have full capacity to do so. And like you guys probably know, the bank doesn't have any money. It uses its customers' money to lend out money. So basically, when that happens, it's a whole trickle-down effect. So this is just one little example. So let's continue on with this example, because a lot of people don't understand that it's not really a $1 trillion stimulus package. It's a $100 trillion stimulus package to start out with, and then it's based off of long-term data. It's really what would it be, $1,000 trillion stimulus just got pumped into the economy. But most people have no clue how the economy works, so they have no clue. And it's actually that was historical data based off of the fractional reserve system, so it's going to be a lot more than this. But let's just get started and give you an idea of how this works. Pay attention. This is the most important finance video you will see this year. I guarantee it. So you have this $1 trillion stimulus package. If you were to simplify it to $1, you put $1 into the banking system, it turns into $9. Like we said, it would turn into more. So going off of that example of the car situation, let's say that you then go and you take your $10,000 loan and you go to the car dealership and you say, I want to buy a Toyota Camry or whatever these guys are buying, 2020 or whatever. Maybe they need $20,000 for that, whatever. Then what ends up happening is the dealership gets that borrowed money, and they don't treat it as borrowed money. They don't say, oh, well, you're the dealership and you got this borrowed money, so it has to stop with you. No, they take that $20,000 that was borrowed, and then they say, hey, all these people are bringing their stimmy checks to the Toyota dealership, and we're selling all these cars. I need a loan from my landlord to expand my business because my business is doing so well. So then what they do is they take out another loan. The landlord or the car dealership takes out a loan, and this loan isn't for 10, 20 bands. This loan is for let's just say $1 million. And so they take out $1 million loan and they expand their car dealership because it's doing so well. And then the landlord is like, wow, we're doing so good. Our all these car dealerships are expanding and we're making all this money. Let's go buy more land. And then they take out a loan and they use the borrowed money from the borrowed money from the borrowed money. Let's go back, take a back step. So who borrowed money first? You had the person that had the stimulus check that borrowed money from the Americans. So this wasn't even money that even existed. This was money we borrowed from other Americans through the stimulus package, went into the banking system, borrowed money from the people at the bank, then borrowed money from the people at the bank to buy the car. Then with the money from the car, the dealership borrowed money from the people that bought the car, who borrowed money from all those people. And then the landlord wants to borrow money from, the money that came from the car dealership, because he's doing well, because all these car dealerships are expanding. So he's like, let's go buy more land. And so now you understand how we go from, this is very, very basic, and it gets a lot more complex than this. I'm only teaching you the rudimental fundamentals that I guarantee you that 99.999% of the planet does not understand this stuff. This is, like I said, the most important. And I'm just getting started. This is going to be a massive video. All right, so that's how we're actually in a $1 trillion stimulus package. Just to start out with, if it's historical, which it's not going to be. It's going to be more than that. All right, so this goes even deeper, because this is how the banks actually steal money, if it already wasn't obvious. So when a person goes to the bank and deposits money, let's say they deposit $1. You guys know at this point that they can loan you out $9, but that was the old system. In the new system, they can loan out whatever they want to give you, and the Fed will back them up entirely. So anyways, I don't know if I should delete this. This was the fractional reserve system. It's even worse than this now, or better if you love inflation. This money is loaned out with an interest rate, let's say 10% on the loan. So the bank is making money on the money that they're lending out, that's their customers' money. So the bank never has any money to begin with. They get funded the money from customers, and then they make money loaning out their customers' money. So they make massive returns on their customers' money. So the bank's never actually providing any value. Actually, I posted another video about this before, and how it was supposed to work, when the Constitution was written. And I actually have a video where I actually quote the Constitution quite a bit. You can check that video out. It's a little bit older, called Banking, War, and Inflation. But how it works is Congress is supposed to be the one that creates money. And the banking system, both privately and with the Federal Reserve, which is the overall system, but it's basically commercial and governmental. Think of the Federal Reserve as the government's bank, and we'll get into that in a little bit, but I got to cover this first. And then what we're talking about right now is the bank that you and me go to, because we're not the government. So you pay money. You're paying interest rates. The banks are making billions of dollars. You want to know what the biggest companies in the planet are? Well, one of them's called Chase. And you know how they made all their money? Off of other people's money. So here's the significance of this. And I explain it very well right here. And I'm actually going to get out the whiteboard so that you guys get a really good understanding of what's going on. Let's see. So right here, and then we'll go to the whiteboard. Fed notes. Download. And then I have a really good video, because I know that we're about to be the most underrated finance channel, but we also are the most underrated crypto channel, and that's not ending. Let's see. Whiteboard. But let's see. Yeah, that's terrible. Free. Dang. All right, I don't have a picture of it, but essentially what you're looking at is you have let me just explain it through this example right here. If we simplify the economy into two groups, we have one group of people that earn their money like building houses, and then you have another group of people earning money by other people's money. And essentially what I'm alluding to is like this banking system and the speculation on assets that's occurring right now. It's very advanced. We'll get into it later, but basically a lot of resources are about to disappear, and a massive wealth exchange is about to happen because it's impossible for the resources to just go away, and it's impossible for money to just disappear. It switches hands, and we'll talk about that a little bit later. But essentially what we're talking about here is you have people that are providing value, economic value. They're providing food, housing, entertainment, whatever. They're providing to the economy. They get paid out in dollars for this economic value. Then you have people that are making money just off of the banking loans, and they're making billions each year. And they're going to take a lot of those resources that a lot of these other guys were working hard with. So now there's less resources, and they're not providing any resources in return. So it's basically stealing. Every single major culture talked about it. It's called usury. And it was actually illegal for the longest time. A lot of people don't actually know how the banking system came up. It was actually a cartel, and how would you say it? The most, I can't really say it without saying any inappropriate words, but they would be appropriate for this situation, but they're just so derogatory, and not gonna say I'm against my character. So essentially you have these people that don't have very good character, and they lobbied for fractional reserve lending, and now we have a forced no reserve lending system. But before, you had all these decent bankers which would only lend out their money, and of course over time the people that started lending out other people's money, charging interest on it, and loaning out money that they didn't even have, they obviously eclipsed the people that played fair, and then they lobbied for fractional reserve lending. So this lending scheme was actually illegal for the longest time. The bankers heavily lobbied again for this bill to be passed. It ended up passing, and it steals a lot of money out of the economy. All right. Banks make profits without contributing any real value, but they receive real value in the form of dollars. Let me explain. And then basically I explained it essentially, and then you can just read this. And then we already showed you the good debt one. Let's see. And I'm going to be making separate individual videos. I think that's most of them. Okay, so let's go into some more advanced topics. So we talked about borrowing money earlier, and I'm going to be talking about borrowing money with interest rates, and how interest rates, basically different companies borrow money and they're incentivized to borrow money or not borrow money based off of different interest rates. And the two things that the Federal Reserve heavily regulates is, how much money is being able to be, spent by the government, which the government actually does the borrowing too. And income tax, which was 1913 is when income tax came out. If you know, as an American, the United States was developed in 1776. That's when the Constitution, and so it was developed in 1776, and then income tax was developed. I believe it's 136 years later, or around that number. And so obviously income tax wasn't in the Constitution. It was actually created with the Federal Reserve. In the Federal Reserve, income tax, all it does, most of income tax, is used to pay off the debts. Most of the taxpayer money goes to pay off the debts from the interest on the national debt without even touching the principal. So I can't really go into too much time explaining that, but if you don't understand finances and you don't understand like principle and all that, but there'll be more videos about this. So that was just like an introductory to, we're going to be going over more advanced topics if this will play. This was shot in 4K, so we'll do 380p, see if it plays faster. I got the highest Wi-Fi up, I don't know. The streaming also does take a lot of energy. And then I got some really cool crypto stuff. You guys know that we're the most underrated. We called the bottom, of course, on crypto. And we did good in real estate and stocks. So this is going to be the best channel to follow for finances, period. And I hope this video is an introductory to consolidate that point. But so you have these interest rates, you have positive and negative interest rates that the government controls, the government being the Fed. And I guess I can talk a little bit about the Fed. So there was a conspiracy theory that the Federal Reserve was started by J.P. Morgan and John Rockefeller, and this was a conspiracy theory around the 50s and 60s. Well, later, John Rockefeller and J.P. Morgan, in their autobiographies, actually both talked about the Federal Reserve and claimed multiple times that they indeed did start it. And there was an excellent book written on it called The Creature from Jekyll Island, and it goes into a lot of depth on the story of how the Federal Reserve was actually created. They actually went down to this secret, or I guess secret isn't the right word, exclusive vacation house called off of Jekyll Island. Jekyll Island was the island that they owned, and they went over to the Federal Reserve, or they went over to their clubhouse off Jekyll Island. I think it's in the Georgia, right off the coast of Georgia. And they planned and created the Federal Reserve. Actually, a few interesting things about the Federal Reserve. First being that it's called the Federal Reserve, but it's actually the third central bank in America. The first one was heavily, I don't know what the right word would be. The first one was heavily, let me make sure I'm still connected, good to the internet. But the first one was heavily, I guess, incentivized. Let's see. All right, we're looking pretty decent. The first one was heavily, I don't know what you would say as far as words go. The first one was proposed, I guess is the most complacent word, was proposed by Alexander Hamilton. And Alexander Hamilton, he was basically like, we need to do a Federal Reserve. And obviously, if you don't know, America was actually started because we were trying to get away from the monetary policies in England, according to Benjamin Franklin, the founding father, or one of the founding fathers. And so he was like, of course, we're not going to do that. And after massive amounts of pleading, because Hamilton was paid to plead for this central bank by the bankers, it finally ended up getting pushed through. After a decent amount of time, they're like, this system is exactly what we thought it was. It's absolutely terrible. It destroys a lot of the wealth from the working class, and we don't want it, obviously. And they destroyed the central bank. The second central bank ended up coming up around 1812 area, when England tried to bring the colonials back to colonial status because they were the property of England. They weren't free people to go and do whatever they want. They were the property of England, and England was fighting to get them back, which they don't really cover a lot in history books. But um, Andrew Jackson was actually the person that ended up helping and fixing and destroying the second central bank. And he actually wrote as his biggest accomplishment, he was actually president, but he wrote his biggest accomplishment was killing the banking system, which was absolutely massive. And he wrote that on his gravestone, believe it or not. And they actually tried to assassinate Andrew Jackson. Somebody put up 2 pistols to his stomach, and they actually misfired. And after they misfired, they caught the guy, and they asked him why he was trying to assassinate Andrew Jackson, and they answered because he was trying to stop the banking system. And then the third central bank is the one that I just briefly covered with the story of John Rockefeller and J.P. Morgan, and those guys, their plan actually failed. I think twice, but at least once they had another Congress person that was that they were trying to use, because obviously they couldn't just create the central bank. They had to go through Congress to write the law. So they took out Congress people to dinner. These Congress people were very corrupt. They took money and they went along with the plans that they were pushing. So the first guy that they ended up getting to push the job, a lot of the other congressmen were like, no, there's no way we're passing this law. And then they manipulated actually the newspapers to basically say, oh, this central banks will be terrible for big businesses. It'll put big businesses out. And they actually ended up tricking the American people and the congressmen into passing this law by getting a very favorable congressman at the time. I forget their name. It's written in the book of Creature from Jekyll Island, but it's also in history. But yeah, the Federal Reserve actually failed. I believe it was 2 times, and then it got passed by a very favorable senator after a heavily manipulated media through the Americans, because at the time everybody hated the big businesses because they took a lot of the wealth. There was no minimum wage. They were very corrupt. It was very obvious. There was a lot of problems, and everybody back then was actually Democratic. And now there's a strong push for Republican, and I don't have a preference on politics. I'm just saying that everybody was a Democrat back then, and that there was massive problems with too much control from these massive people that were corrupting the politicians. They had all the money, and then they would buy the politicians, and the politicians were broke, so obviously they would take those handouts. And the American people pleaded multiple times for, at that time they were pleading for things like minimum wage. The politicians wouldn't pass them, not because they didn't necessarily believe that there should be, but because, again, they were paid not to. And it was very cost effective for these big bankers, like saying blatant names like J.P. Morgan, to just lobby for extremely corrupt and unfavorable to everybody but himself banking laws. It was extremely cheap for him to just pay politicians and say that there should be no restrictions whatsoever on workers, times, So a lot of these Americans actually ended up working massive hours. Some of these hours were 20 hours a week. They were getting paid almost nothing. They could barely survive. Most of them had to live in multiple different houses. And then on top of that, you eventually had the Roaring Twenties after America was heavily enslaved. What ended up happening is you had something called the Roaring Twenties. America had built up and worked so hard and been forced literally by law because, again, you had all these corrupt politicians. That's why, Mark Twain, one of the biggest, most influential guys in the space, which is, this guy's absolutely massive. He wrote the book Huckleberry Finn. And is very well respected by academia. He said, the time was like the Gilded Age. And why did he say it was like the Gilded Age? Because you have this golden A coin, basically a gilded coin, is a coin. On the outside it's gold, but on the inside it's corroded metal. So on the outside, America looked really good. It was rising to power. But it's kind of like China today, where it looks really good on the outside, but everybody knows it's, there's a lot of communism, there's a lot of like sweatshops, there's a lot of, and actually that's how America was previously, when they were rising to power. And so it looked good on the outside, like, oh, America's doing well, but, it's really under the weight of all these corrupt politicians. All the money is being ciphered all the way up to the top, and these ginormous businessmen are making all the profits. Any businesses that stand in their way, they're selling them, they're buying them, they're forcing them out of business with corrupt business practices. They're doing all sorts of things so that a legitimate business cannot stand in business, so that there's literally no competition, and they cipher all the power, all the money up to themselves, and then the only people that can potentially protect the people, the politicians, are getting bought out by these people that have all the money. So it's a never-ending cycle. That's why a lot of historians call them robber barons. And there's a whole history with that I'm not really going to go into. And then essentially you have what's called the Roaring Twenties. And the Roaring Twenties is when America's doing well. They were the slave class for the longest time. They made no money, all of this very corrupt policies. And then eventually their economy was forced to boom because they were producing so much, they were working so hard for such low wages, and there was so much innovation at this time. You had the railroads, you had the railroads, you had the steel industries, you had Andrew Carnegie, you had all these guys that were heavily innovating, and America was working extremely hard for very, very, very cheap wages. And eventually America just had to boom. And so then everybody was speculating on the stock market back then, and they were actually leveraging positions on the stock market. Everybody was putting all their money into the stock market. Everybody was like, oh, the economy is doing well, it's booming. The job at the time was to speculate on the stock market. And everybody was doing that. And then one day, the entire stock market collapsed. This is an infamous date called 1929 Black Thursday, when the stock market crashed, and it's what historians label as the Great Depression. What they don't label and what they don't take into accountability is the facts of the stock market. So when you buy stocks today, you buy it from a computer, all sorts of stuff. They didn't have that back then. It was one room. There were people in the room. There were legit stockbrokers. They would buy the accounts. And so the only way that the stock market could have crashed in 1929 is if the wealthiest people, because again, you have to understand the context of history. These people didn't have minimum wage. These people were very poor. They were investing everything they had into the stock market. These people didn't have enough money to crash the market. The only people that had enough money to crash the market were the wealthy elites, and they ended up crashing the market because there was literally no other feasible way. They owned the majority of every single company, like we talked about, because all the money was getting siphoned up to them. They had all these massive employees, and there were no laws whatsoever. These guys were working 20 hours a week, and they could barely afford to feed themselves. They did not have money. The people that had money were these wealthy elites they called the robber barons, and these guys ended up crashing the stock market in 1929. And then what ended up happening is and this is really important, when you get a historical context of what's happening now, where everybody's speculating very heavily into the stock market and there's a potential crash and everybody's on leverage and, a potential Great Depression, and then with this hyperinflation, because back then, the Federal Reserve was very corrupt, and they actually planned who was going to be in the Federal Reserve and adjusted for interest you had, which is called real interest rates, adjusted for interest rates is called real interest rates, actually ended up rising at this time, and it actually ended up crushing businesses. So the Federal Reserve actually ended up purposely destroying companies. At the same time, they crashed everybody's wealth that was on leverage because they crashed the stock market, and everybody was putting their money into the stock market. And, this seems very similar to what's going on today. And then because interest rates were risen, people didn't want to borrow money. People didn't want to hire help. And, the economy, because the Federal Reserve had the ability to print money, but they didn't print money to save the economy, everybody ended up holding their money very tightly, and the economy actually ended up just crashing, not because of hyperinflation, but because of stagnation. Basically, the money wasn't changing hands. Everybody had money, but nobody wanted to spend it, and because nobody wanted to spend it, nobody was getting money, and so everybody had all the supplies, but everybody was way too afraid to spend it. Because they were afraid that they weren't going to get business, and it was a self-fulfilling prophecy, and it ended up causing something that you might be familiar with, which we talk about, being from like 1930 to around 1940, called the Great Depression. And is something like this possible in today's economy? And it all comes down to a lot of factors. Obviously, still extremely important is interest rates, and how conservative or how risky is the Fed going to be with interest rates. How is the Fed going to react with quantitative easing, which is what the normies call money printing, and then quantitative tightening. So historically, the Fed has been absolutely terrible, and purposely crashed the stock market, and we later find out through multiple different sources, which in the 50s was a conspiracy theory, but we later know because they wrote about it in their autobiography that no, in fact, they actually did crash the stock market on purpose. And there's reasons as to why you would crash the stock market if you were the wealthiest people on the planet. If everybody's speculating on assets and getting rich on assets, then obviously America can only hold its dominancy for so long, and we're really going to get into that later. But regardless, it kept Americans in the slave class for pretty much, at least up until the 80s. The average American had no shot, no chance. And then towards the 90s, they started heavily getting into this whole capitalism idea where you're a bad person if you don't drive a nice sports car, getting anybody to, destroy their wealth, and more psychological manipulation more than anything else. But really what we're looking at in today's economy with today's Federal Reserve is today's Federal Reserve, you'd actually be considered a psychotic, I guess, psychotic conspiracy theorist if you were to say that the Federal Reserve is purposely crashing the economy today. The Federal Reserve is actually helping out the economy massively, and the chairman is actually obviously an academic in economics, and I know that for a lot that doesn't say much, and I mean, I agree, but he is helping. And it's the difference between, historically when they purposely crashed the stock market, and this time, it seems like their plan is, hyperinflation. We're not going to get into that. That's just way too advanced. But my point is this. You're looking at a hyperinflationary situation and a possible depression. So what does that look like? Well, everybody's leveraged out or potentially getting leveraged out, and a lot of these companies are forced to speculate on their balance sheet. They're forced to speculate on acquiring new assets. If they don't acquire new assets, if they keep their dollars are going to be worth less, not worthless, but considerably worth less, and obviously not a store of value to hold any monetary purchasing power. And when you look at real interest rates, and when you look at real growth rate with the economy and holding economic value, and I went over this in another video, but interest rates are, or inflation rates are, on average, they can be 2 to 10%. And that 2 to 10%, when GDP annual growth is around 12, conservatively like 9 to 12%, our monetary value should be raising. We should be making more money on our dollars, but because we're on a credit-based, debt-based system and not a gold standard, we actually lose money with inflation. So the fact that we're going to see the fact that in normal, what I'm saying is in normal situations when we're supposed to be making 9 to 12 conservatively percent on our money, and we're losing 2% to 10%, on the most conservative metrics, that's a loss of annual buying power of monetary value of 11%. That's conservative. That's the conservative loss. And that's on a normal circumstance. Obviously, with all the printing that's going on, which it's not printing, that's just what I say to the normies. That printing is obviously in normal times, if we're losing 11%, it's very, and a lot of really good economists have come out and say it's more going to be like starting out another 10 to possibly 20% annually. And then when you look at that constructively, like what does that really mean if we're getting 10 to 20% at least inflation rates a year? What does that really look like? Well, it looks like a lot of things for every major thing in finance, and you really see that with, we haven't even really started yet, and even assets like vehicles are starting to go up massively in value. If you've seen this year, when usually they depreciate, really what it comes down to is you're looking at 10 to 20% inflation. If that is the case, then how, if you're making $100,000 a year, how are you going to sustain yourself? Because the next year, adjusted for inflation, you're going to only be making $80,000 a year, and adjusted for inflation, the next year you're only going to be making $65,000, and this is obviously going to continue. And the only options they have is to keep printing, at least until there's stability in the economy. They only have two options, really. Well, three with quantitative tightening. But really, you have to lower interest rates, which it seems like that's what they're going to end up doing in the future. It looks like they're going to be printing a massive amount of money for the foreseeable future, and then lowering interest rates. But no matter how you cut it, that's going to have massive implications on inflation. And when you're fixed on a salary, you have two issues. The first issue is you have these companies, and these companies, the best thing that they can do, the thing that will generate them the most money, is not providing their goods and services. It's buying back their own shares, which we saw a lot of, which is just insane, that companies are buying back their own shares, generating more money than their goods and services. And then, like, for example, Bitcoin with Tesla, that's not something that you can ignore. They bought $1.5 billion worth of Bitcoin, and that made them, around $700 million, which was about how much they made on their best year in car sales. So it makes more sense for them to allocate their balance sheet, their cash reserves, to Bitcoin and speculate than actually provide goods and services into the market. Obviously, that's going to have absolutely massive implications on the long-term effects of the economy, and that's something that needs to be at the forefront of everybody's mind, is that whether you're looking at it from a macro perspective with, I think of, businesses as like people, but like massive, financial people. Like you have your balance sheet, your income statement, your liabilities. And, whether you're a person or a business, it makes more sense to speculate on an asset class than provide, economic value. And you kind of see this with everything from, you have the normal middle class person that's experiencing massive increases in property value, usually more so than what they're making on their job. And then you have the exact same thing with businesses. Like I said, the buyback shares, and so you have this massive speculation asset bubble where people are forced in this system to speculate on assets if they want to maintain their purchasing monetary power, and because that's not going to happen with U.S. dollars. And so you really have two situations. The one obvious situation is that the Federal Reserve doesn't keep printing, which, like we said, it's not printing, and they don't lower interest rates, and the economy collapses. So there's only two options. They keep printing, and they keep lowering interest rates, or the economy collapses, because a lot of people are already leveraged highly as it is. Companies were highly leveraged before, and with the Federal Reserve already teasing that they're going to print, a lot of companies have massively leveraged even more than they were already speculatively in 2017, which was absolutely massive before. They and this is just generally speaking, but this trend seems to continue. And so you have this massive asset bubble, and basically if it bursts, all the people that are leveraged are going to get liquidated, and based off of the loan, or the borrowed money, however they're on margin, whatever the case is going to be, that's going to implicate into a massive crash. Then they can pump up more money. If they pump up more money, the markets are just going to recover. And so you have one situation where they stop printing money, they stop they stop lowering interest rates, and there's a crash. And then if they decide to print more money after that, then there's a recovery. And so you have a crash recovery type situation where you have basically housing market crashes and then pumps, housing market crashes and then pumps. The other situation that you would run into is if they continuously pump, that's going to force everybody into, like we were just talking about, highly leveraging themselves into a highly speculative asset bubble where everybody is forced to speculate. And it's just a never-ending cycle. You put all your money into these assets, they make you a massive amount of money. You don't produce anything for the economy because it makes more sense to invest into these highly speculative assets than it does to produce for the economy. And the Fed just has to keep pumping that up. And if it doesn't pump it up, the asset bubble will crash. But because there's already so much money pumped into the system, it'll recover. And like I said, it's a wave type situation. And that's kind of a small percentage of the introductory to what we're looking at right now with the economy. And I actually had the pleasure of talking to one of the biggest hedge fund managers on the planet. Actually, one of my friends' dad works for Vanguard and is one of the top advisors. He's talked to Bill Gates, like all these big guys. He's literally one of the smartest guys I've ever met, and he's in charge of billions of dollars, and he manages billions of dollars, and he talks to the biggest people on the planet, like Call of Duty guy, the guy that made Snapchat, all these guys. And I said, there's this huge, massive speculative bubble right now going on assets. Everybody's speculating on assets, and obviously you're one of the biggest hedge fund managers on the planet. That's what I told him, and I said, you're a really smart guy and all this, and really, what do you think about this? What do you think about all, the stimulus package, and obviously, the no reserve lending, and so there's a lot of, new changes to what's going on with economics. And he said, he told me two things, and this, in and of itself, like, you probably learned a mind-boggling amount of new information, and if you didn't, you just didn't understand it. But the other thing that's going to make this video absolutely massively valuable is what he told me. And he said, this is one of the biggest guys, so even, if he's wrong, it's the fact that it's that it's the fact that it's that bubble down self-fulfilling prophecy. He's managing billions of dollars, and you know, if you know about liquidity and specifically derivatives market on the stock market moves every single market because of derivatives, and we don't have time to go into derivatives in this video just because again it's a very advanced economic process, but that's where most of the money is stored, essentially making bets on different commodities is a lot of what the derivatives market's about. But what you're looking at is what he told me is that he said the governments have proven, the governments around the world have proven that they will do what it takes to keep this the stock market from collapsing. That's what he told me. He said, you know, because I said, are you worried about another crash? You know, highly speculative, highly leveraged. And then obviously all the manipulation. Like with Wall Street bets and all that stuff. And what he says is that the governments all around the world have proven that they're going to keep printing money. They're going to prop up the markets, and that's good. And essentially what he's expecting is that a lot of the asset prices, and he's a hedge fund manager, and a lot of the prices are already priced in for all the stimulus that's coming in. So what he's expecting to happen, and again, this could be, regardless, I think this is one of the smartest guys I know, but regardless, it's going to be self-fulfilling. These guys are all thinking the same, and they're the ones that can potentially control most of the planet with things like derivatives. They have most of the money, and they're managing the wealthiest people on the planet's money. So, what he told me is that essentially he says that the governments around the world have shown that they will do what it takes to keep the markets propped up, and there is always the possibility of a crash, but basically a recovery with that money printing. And that's really what I got out of the conversation. And so really the takeaway from that, and really, at the end of the video, it says destruction of the entire system. There's really only one major way that the entire system can self-destruct on itself with all this money printing, which again isn't money printing, is the bond market. So the bond market, if the bond market does collapse, if there's so much, money printing, if there's so much hyper and speculation that the dollar just becomes inevitably nearly valueless, and it doesn't make sense anymore to give the money it doesn't make sense. And if it doesn't make sense anymore to give money, USD, US dollars to the government, basically if it doesn't make sense from a risk to reward ratio to give the government money for bonds, and the bond market was to collapse, that would limit the Federal Reserve's ability to print money, because they don't actually print money. And then if that was to happen, it would also make it very hard for them to insure the bank accounts, which is, one of their policies is to insure a lot of the private banks. So a lot of people don't know that because it's a newer provision around the 2008 time when you had all these banks failing. They had new legislation that stepped in and said, if these major banks fail, what we'll do, and a lot of people were saying if Wall Street bets collapses, because they were talking about how do you say they were talking about what would you say? They were talking about basically the underlying factors that the process of shorting, and basically how because these Wall Street guys borrowed so much money, and now they're forced to pay back a lot higher from what they initially purchased, and they owe so much money, and the bank doesn't even have that money, that the banks are going to collapse. Well, what they don't understand is the new legislation that says that the Fed's going to back up all those private banks that are lending to them. Well, anyways, the bank wouldn't be able to get backed up if the Fed didn't have any more money to print, and then on top of it, the Fed wouldn't be able to print any more money, quote unquote, print any more money if the bond market was to collapse. And so really all we would have left is interest rates, and the Federal Reserve has been extremely conservative, specifically in the United States. There's different central banks all around the world, and the Bank of England was talking about negative interest rates and potentially lowering those, and just generally the implications for that would be it would actually cost money to store money in a bank account, basically incentivizing people to spend money or speculate on assets, and then basically to borrow money, to loan, to again speculate on economic growth would be extremely cheap, if what it implies in the name negative. So the banks would actually be giving you money to to loan out. And the United States said that they didn't want to do this. The Bank of England said that they were toying around with the idea and running numbers. And it looks like really what the United States is looking at is the idea of potentially the bond market collapsing, and as a last defense using the negative interest rates, which it would be, besides, QT, which is, so that's really what we're looking at right now on the Fed side. And they still, I guess the main takeaway from this video is, there's like he said, and this massive hedge fund guy, that's super educated. I don't remember how many degrees he has, but he's a really, really smart guy. And then obviously you can tell that I know a lot about finances, not as much as him, but so the main takeaway is that there could potentially be crashes, and if there are crashes, and there's a lot of reasons for crashes. For example, like the real estate market, if people default on their mortgages, again, there's a lot of speculation saying that the government's not going to allow people to default on their mortgages, and so far we've seen that to be true. But really long term, that's speculation. But if they continuously allow people to not default on their mortgage, what they're going to be looking at is, if you don't allow people to default on your mortgage, and no businesses are profitable, you revert to what a lot of economists have been toying with the idea of, called universal income, where essentially the government just gives you money, like communism. And this is, not political at all. This is just, if there's no businesses that, if one business goes out, it's a domino effect. It's like Microsoft. Microsoft's a B2B business model, business to business model. So if a lot of companies go out of business, then Microsoft loses, say, half their customers, and then they have less revenue. Their less revenue is less revenue for their employees, whatever, and it's a self-fulfilling domino effect. And so they toy with the idea of what's called, what did we say? Universal income. And universal income would basically be paying citizens money to survive, and basically being forced, like, to basically take this money. Like, there would be no way really around it. And this seems to be the common theme that we're headed to in the long term, for the reasons I just talked about. With negative interest rates, after only so long can you say that the economy is just crapped out, because like I said, the speculation, the fact that there's going to be so much money constantly coming into the system, and there's only so many assets, and it makes more sense to speculate on assets than produce them. And if everybody's making all this money, they're just going to buy up all the assets. and then they're basically going to trade assets from person to person with the speculated money. So I think that's most of the basic introductory to finances. These are all very, very, very extremely basic concepts to finances. Most of this stuff doesn't get taught in university, namely because first off, they're not smart enough, and second off, it's so new. Everything that's going on with the economy is so new that they can't comprehend it yet, and so therefore they can't really teach it, and obviously they can't put it in textbooks. But this is absolutely monumental premise for the basics of what you need to understand going forward in the economy. It's no longer, if you go with Dave Ramsey's save money, save money, save money, and the projected loss on that is most likely going to be 30% in the next year or two, just based off of some Forex TA. And Forex is the trading of commodities. And it really speaks levels to when you look at, what's going on with the DXY. So the DXY is a basket of commodities against the United States dollar. So the United States dollar is the the United States dollar is the reserve currency of the world through the Bretton Woods Agreement, and because of that, every single currency is backed by it. So it doesn't make sense if every single currency is backed by the dollar to compare, the dollar to another currency, because they're all backed by the dollar. They still do it though, and that's called the DXY. So when you're looking at the DXY, which is the dollar index, which what is the dollar? Well, it's a fiat currency that doesn't have any intrinsic value. So how do you find value from it? You compare it to a basket of other currencies. And when you compare it to a basket of other currencies that are also depreciating at the same time, if not more, when you see all these, I don't even want to put a term, a verb or a describing word to describe them, but you have all these different countries like China, the UK, they're all printing money, so they're all depreciating against the dollar, with the dollar also depreciating. So if they're all depreciating and then you're comparing them against each other, and the dollar's already depleted 10% compared to the others, you have to understand that the overall system is down massively. And it's very hard to constructively look at that because of the Bretton Woods system and the metrics that I just described on how we look at how currencies are appraised, because again, they don't have any intrinsic value. And that's our current system of appraising them because of the systems inside of the systems, with the Bretton Woods, which was created after World War II, back when the United States actually had very favorable standings in the economy. And it's debatable on whether or not that was favorable with the other countries, but regardless, that is the reserve currency. And so, if you go through this model of saving money, you're already down 10% on the year, a little over 10% on the year, with a projected 30% loss on the next 1 to 2 years. And that's on the DXY, which doesn't even factor in, the loss of monetary power from, all these other currencies that it's hedged against. Because if you're comparing two apples that are falling down simultaneously, and you're just comparing the small difference that they're falling down, if you're just comparing their difference, you're not actually seeing the entire fall. And so that's massively important. And I think the fact that, earlier this year there was that statement out that 20% of all the money is newly printed money, and that's old information. I think that more so speaks to what's really going on. And then obviously GDP, how much money is being produced by the economy is down massively historically. It's usually up like what, 10 to 12%. I'm not entirely off the top of my head, but something like that, and it was negative this year. So you have GDP, you have products and services produced, obviously, because we were in the lockdown, negative, and then you have inflation going, it's not parabolic yet, but 30% is more, projected 30% on the charts against, again, them depreciating against each other, which is, so it's obviously more, says a lot about the current state of inflation. And it's not just the inflation aspect, it's the fact that all the different economics, when you factor in what's being produced, because usually we're producing a massive amount and then there's a small amount of inflation, and usually that inflation is from economic growth and major businesses borrowing money, which is not the case this time. So really when you look at like Bitcoin, when you look at housing, when you look at everything else, this is what you see. And that's very, very, very basic fundamentaries into economics and what's going on with the current situation. If there's any questions in the comments, I'll take like a question or two before I head out. But this was just a very basic video describing very basic understanding of economics and what's really going on in the economy right now. And yeah, it wasn't clickbait. And then we'll go over this video next time, but this video is quite interesting. It's 20 minutes long. All right, it doesn't look like there's any questions. So yeah, that's a very, very basic understanding. We're going to have a lot more videos coming out on finances. This is obviously by far the most underrated finance channel on the internet, because we obviously did not clickbait you. We told you what it takes for the entire financial system to collapse. We also told you the possibilities of what's going on with the finance system, and we explained basically in basic terms what's going on with the finance system in present day, and kept you updated on a lot of our current systems. The last thing I'll say before I go is, you look at, they have this, pressing idea of income tax, or not income tax, asset tax, where essentially because so many people are making so much money on all these different assets, and they're making more money from these assets than their actual jobs, they're potentially looking at taxing assets. And if that is the case, where you have and I get that you already have long-term capital gains, and I get that, but they're looking at like long-term, they're looking at, I forget the exact word, but basically where they tax you every single year regardless of whether you sell or not is what they're looking at. And if that is the case, where they're going to be taxing you whether you sell or not, that's going to cause a lot of speculation out of the market, which is going to be good and bad. It's kind of, just letting the normal person, never win. But regardless, whether you have to speculate on the assets or whether you don't because of these taxes, this is by far going to be the best channel on the internet as far as it being underrated. There might be another better channel on the internet, but this is going to be one of the best internet channels, because you need somewhere to put your money. Obviously, regardless of what happens with the economy, you need to get rid of your dollars, and you need to put them in the best assets available. And we called the bottom on cryptocurrency. And there's that overwhelming, I guess, cloud where it says that, well, what happens if they ban Bitcoin? And people say that and they make it sound like FUD. And it's really not, when you look at it from a historical context, where they banned gold. And you have to understand the historical context of why they banned gold. And it was actually Nixon that did it in the 60s. And Nixon banned gold in the 60s because they were having inflation issues obviously a lot less severe than what we had today. And a lot of people were using, gold as a hedge against inflation. And what that did is a lot of America's power came from the fact that they used their dollars to basically control everything. And like we said before, what makes the dollar valuable? It's the fact that the Marines are coming in to back it up. It's the fact that it's legal tender, and the legal system operates with it, and you pay your taxes in it. And it's not necessarily, a lot of people think, well, what makes the dollar valuable is that everybody thinks it's valuable, and that's just blatantly incorrect. But so there is validity to the statement from historical context with relevancy that you have you have in the 60s, you have Nixon taking gold, and then what is Bitcoin? Essentially digital gold, trying to because they're trying to accomplish the same mission of hedging against inflation. And so if they were to ban gold, it would be out of because they don't want all of these companies like Tesla to put a massive amount of their cash balance sheet on to they don't want massive companies like Tesla to put their cash balance sheet into Bitcoin, speculate on it, and then basically, reap a massive amount of revenue from speculating on an asset like that. There's obviously a multitude of different implications for why that's negative with inflation. And then also like I said, it comes down to the government, and the government having less power with USD. So are they going to ban Bitcoin? Potentially, but at the same time, it's not like they can ban real estate. It's not like they can ban stocks. It's not like they can ban a lot of these other things, and really the only thing they can do is tax them on terms. Like every single year they tax different asset classes, and if that is the case, then you would have to be more, if they were taxing every single asset class, then you would have to be less speculative and more objective with your investments. And that would, because right now with money being so cheap, and with lending being so cheap, it's so easily to just leverage a position, take out a loan, borrow a bunch of money, put your money into Tesla, and then watch it shoot up massively like never before, or put your money into Bitcoin and become a millionaire. When my friend answered the phone this morning, I said, "Do you want to be a millionaire?" And he said, "Yeah." And I said, "Go borrow a bunch of money and put it into Bitcoin." Would that work? I don't know, but you can still declare bankruptcy if it doesn't. So, but I was joking with him, and he knew I was joking. But so the system is changing. Assets are changing, and there's a lot of speculation both in the market side and the economic side. So being completely constructive and objective, what I mean is there's speculation in the fact that everybody's speculating on these assets and making a massive amount of money with them, which is not healthy for the economy for the last, however long we talked about. The other thing that's not healthy is, we have a relatively good understanding of what the Fed's going to do, but it would be nice for investors to see the exact game plan going forward with the Federal Reserve, so we can understand, negative interest rates, they've been relatively clear. They said that at this point they're not looking to do that, and they've been very public about, printing, which isn't printing, but with the money, with the quantitative easing. And so really just more clarity with that. So there's speculation on that. There's speculation on what the Fed's going to do. And then there's speculation on, what was the last speculation? There's speculation on something else. But we basically need all these cleared up. And then that will really give us a good idea of there's really only three economic layouts. The first one is we have a hard crash, and they cut off, the economic easing, the economic tightening, whatever. And then the second one is that they do it conservatively and there's crashes in the market. And then the fourth one is they just, basically print their way until they switch to something like negative interest rates and they ease their way off of it. So anyways, we're going to be covering all this on the channel, and I'm going to be going into more in-depth, more concisive points on this. But this is, if this was a little bit confusing, a little bit advanced, or if you got into cryptocurrency and you didn't know about any of this, congratulations, because this is life-changing, and the fact that it'll change your life as in you won't become like slave is not really a nice word. It's derogatory. But if you constantly are putting your money into liabilities like food, rent, car payments, and you're in a job and that job doesn't increase with inflation, like I don't know a single job that increases with inflation. Let's say you make conservatively, let's say you make a little bit more than the average American at 80,000, and then with inflation, let's just say it conservatively hits 20%. You're making significantly less because of inflation, and that's on that first year. And then obviously 5 years from now, you're making factored out for debt, guaranteed, half what you would have made. So you go from making 80,000 to 40,000 when factored in for inflation, and then on top of that, everything cost more, and so you're really making more like 20,000. And this is for and people know that you can't really live off of $20,000 a year, and this is conservatively for people that are doing better. For younger people, this would be even worse. And then on top of that, you see everybody accumulating more and more wealth because they own the houses, they own the real estate, they own all these different things. And so they're making all the money. And so when they make all this money, then they go and buy more stuff, and they're buying more, stuff from the supermarket. They're buying more of, and then you get less and less and less, and then the prices have to go up even more because they're buying everything up, and you're constantly having to work, and you have this basically factored in for inflation both from your salary and from prices. You're basically only making $20,000 a year in today's money when you're higher earning American. And then essentially what would happen from there is you'd be making even less because everybody that owned assets would be making even more than you. And then because everything would go up in prices, your rent would also go up in price, and your car, if you were leasing a car, it would cost you even more money to lease another car. And so you would essentially go broke unless you would literally have to, you would first off be a slave because you would be working for the system nonstop and you would own absolutely nothing and you'd be forced to work just to survive. I don't know what a better term for it is, and I really do think the elites had this all planned out, and there's a lot of good reasons for that I'm not going to get into, but essentially this scary situation that I think a massive amount of Americans are going to find themselves in. I mean, I was huge into real estate before I got into crypto, and I know more about real estate than I do about crypto. When you look at the statistics, most people prefer to rent over than buy. Most people prefer to lease cars than buy them. And I think the statistics have changed a little bit, but there's going to be a massive, overwhelming majority of people that are going to be on salary. There's going to be a massive overwhelming majority of people that are going to be leasing, and those leases are going to go up and up and up with inflation, and their salary is either going to stay constant or factored in for inflation. So literally they have to beg to old Uncle Sam, who we'll see, we've already talked about history and how in the past these corrupt these bigger business owners, the absolute elites. We're not talking about the billionaires. The billionaires aren't elites. We're talking about the trillionaires off the paper. These guys pay the politicians, and so hopefully they'll give you universal income, because if you mess up, if you rent everything, you're either going to be a slave and barely surviving, if even surviving, or you're going to have to beg old Uncle Sam for universal income. There's no way around it. If rent is going up with inflation and inflation is increasing massively, if leasing is going up, the cost to lease is going up massively, if food prices are going up massively. I mean, this is just inflation, and we're about to see inflation like we've never seen it before. It's just getting started, and it's already costing more money to buy cars. And you already know that, in a little bit, it might be illegal to own gasoline cars. So then that's going to force everybody to own, very expensive cars because of CO2 emissions, which, I don't know if we're still alive. Did they cut us out? We're trying to help out the working class. They're about to take us off the air. They don't like that. I mean, imagine if they taught you this stuff in school. Well, you probably wouldn't go to school because you'd be too smart for that, and then that would be the whole issue. You could start up your own business, and then, but then you wouldn't need the system anymore. And you see where the problems underlie. If you start up a business and then you have a family business, then it grows, and they don't want that. What did John Rockefeller say? That he said sin is a sin is a this is like the richest man in America. He said all sorts of the craziest stuff. Competition, comp is a sin. It's a little slang. I always like saying comp. Is a sin. John Rockefeller right here. Competition is a sin. It is simple when you think about it. There is nothing gained from competition. Everybody is competing for the same known thing, hardest way to achieve something new. So, yeah, I mean, this is really like the Huffington Post. They always, with the media, but really what he's talking about is competition as far as, he's talking about, what is he saying? He's talking about competition in terms of economics with different businesses. He purposely bought out all the other companies. He worked with all the other companies, bought them out, whatever. And he doesn't like competition. And there's a direct quote from him about how competition is a sin. He just said the weirdest stuff. But anyways, we'll talk about economics more another time. I might be streaming. Oh, it's too late. I'll stream some more crypto stuff. My long's doing really good right now. I'm just going to close with a little bit of crypto, because really, when you become really good at economics, you realize, hey, the best place to be is crypto. So our long's doing okay. We're probably up like 6% right now. But really what all this means is, I mean, if you put your money in Bitcoin right now, you are chilling, especially if you got in at the bottom like we told. We said get in at the bottom. I went on social media. I went on every single social media platform. I was like, get in at 11. Imagine if you would have got in at 11. You wouldn't be stressing about finances. You wouldn't be stressing about the global elite trying to enslave the working class. So this is the 200-week moving average. So we call this the 200 MA for moving average. And really what you're looking at right here is a heat map of Bitcoin. So Bitcoin potentially can save a lot of the issues we're currently facing right now. And this could potentially put us back on a gold standard, but this is highly speculative that this would occur for a multitude of reasons that we're not going to get into right now. But you have Bitcoin right here, and essentially it's right here. I'm legally colorblind according to the military, but this is, I believe, green or light green. Like I said, I'm literally colorblind. but literally, but something like we're right here. And so we have all the way up until this red area. So we're looking really good on this 200 EMA moving average. So essentially what this is this is Bitcoin's graph right here. And then this is the 200-day moving average. And what you'll see on cycles is that Bitcoin constantly comes back down to test this 200-day moving average, peaks up against it, and then eventually it's so high against this moving average that it ends up coming back down. And that's bull markets, bear markets. We talk about that a lot on the channel. So definitely, you literally can't afford, unless you're Satoshi Nakamoto, not to survive or not to subscribe. All right, so this is the Bitcoin MA multiplier. So it uses this equation right here to figure out basically how we're doing in the cycle, and then basically just isolating this level right here. It's saying the top is around 57, but that's obviously, as you can see, this is slowly sloping, and the x-axis and y-axis, the y-axis slowly creeps up in perspective to the x-axis, if that makes sense. Like right here, you know, this is 40, 48, and then this right here is 42. So, you know, this is a $4,000 difference, and it didn't move up a lot. And then the fact that if you continue to trade sideways, you can move up more and more before potentially hitting. This is just one metric, potentially giving a sign. And you know, if we have one and it looks like we have a multitude on the charts of different patterns that could blow past that projected level all and of themselves. This is the stock to flow ratio, or stock to flow model. This is awesome. This equates in different halving events, which halving events is cuts the created supply of Bitcoin in half, making it Bitcoin more scarce. I'm not going to go too much into it, but essentially, as you have the blue, this is like the accumulation area, and you can see how ridiculously accurate it is. It calls the bottom and then says like this is where you should accumulate, and then you know, as we move up this chart is essentially where the higher we go up on this stock to flow ratio, the more risky it becomes. And right here we're at the yellow, so we still have a lot of room to run up before we're at the, I believe, orange. Again, I'm literally colorblind. All right, so that's stock to flow. That's 200-day moving average, which are two of my favorite. And then you have the pie chart. Pie chart uses these two moving averages. So this is the MA, so moving average 350 day, and then this is the MA moving average 111 day. And these are the average prices in there labeled right here. And basically when this smaller line ends up crossing the bigger line, or it would be the other way around. This one right here, this bigger line, when this bigger line ends up crossing this line right here, it tends to signal a top. It's not entirely accurate. It's a decent indication. But if you can see right here, it crossed and it was a lagging indicator right here, lagging indicator right here, lagging indicator right here. So we'll go close that out. This is Bitcoin logarithmic growth graph curves. So auto scale it out, and then we'll press the zoom in. We'll pan it. And so we're right here right now. Can we zoom in? Boom. All right, so this is essentially potentially the top, the high div, and it's saying like right around 100,000. Now this does go up potentially as the price goes up, I believe. It should. It looks like, yeah, it goes up a little bit. It's hard to see, but it does. this line is definitely, as time goes on, the potential for like a higher coin goes up, and a lot of it has to do with like what I said. It has to do with those moving averages we were looking at, and then a lot of it also has to do with the how do you say, relative strength index, which is what we look at a lot on technical analysis, which is RSI. And basically the longer it holds these levels, the more established these prices are. So we could potentially hit this 100K level, but the further we move out, the longer we establish these prices before having a volatile swing, the more likely, because of, like I said, technical indicators, fundamental basic indicators like the relative strength index taken into account, you could see higher levels like this, just depending on how much we stagnate out of the price, just depending on if that does occur. Another famous or favorite chart is going to be this one right here, which is the rainbow chart, and basically it's another logarithmic scale of the previous price action and how it interacts on again this logarithmic scale like we saw before, but essentially just showing this curved graph of factoring in historical data, and really this is the right here, this is the key, basically saying like if we were to hit what is this, 123,000, this would be maximum bubble territory. But this would be if today we hit 123,000 on Bitcoin, it would be like a sell, or 92, it would be a serious sell. Whereas if we keep going up, if the price keeps interacting at these levels, then potentially we could hit 500,000, which who knows. But it really comes down to how much we're consolidating at these levels before moving higher on these logarithmic charts. And they do have validity, and they're obviously relatively accurate. You can only get so accurate, and these are kind of nearly some of the best indications that we have. But when you look at this price right here, how it called the bottom perfectly, as we come up, a lot of the experts in the space are projecting something around 300. Let me pull this full screen. Okay, so a lot of the experts in the space are projecting something like 320. If we were to potentially hit 320, and then obviously we're not going to come down right away, and then if we were to come down, over a sustained amount of time into the next halving, potentially the bottom of fire sale, a potential bottom for Bitcoin would be around $46,000 at a good price. So what I'm saying is that what's Bitcoin at right now? It's at 52. Well, if it hits 50, if it hits this projected target right here of 330, which is again a lot of the biggest experts in the space. This isn't me saying this. This is some of the most well-respected people in the cryptocurrency space. They're saying, well, a reasonable target is 330,000, all things considered. If you then look at this logarithmic scale right here, as we continue to go down, because we're not going to hit this level and then crash all the way down to the absolute bottom before just scaling out. If that was the case, that would negate every historical idea, which for basic fundamentals, like there's people that aren't selling at certain levels, and it's not even really possible. It's obvious that we're going to come back down like something like this. And if that's the case, where we hit, this potential, this is what they're talking about, these levels right here. And then as we come back down and find a bottom, potentially in the next cycle, the best you could get Bitcoin at would be 45. So when people say, is 50 too high? Is 52 pretty high for Bitcoin? Is 51 pretty high for Bitcoin? I mean, next cycle, the best you can get for it is probably 45. And 45 next cycle is most likely going to be around what 5,000 is this cycle. And you see that from these charts. All right. So Ethereum. So the main thing we're looking at with Ethereum, and then I'm just going to look at a quick look at the DXY. So let's take a quick look at ETH. Oh, I was doing. And then if anybody's new and you're looking for the title of the video, I did a huge video before I started talking about crypto. And then if you're looking for crypto, I'm just looking to finish this out. And then I'll keep you guys updated tomorrow, but there doesn't look like a massive amount. So we did get this bounce right here, and really we're looking at like potentially this area, you know, all this stuff right here. If we can break this, you know, this right here and this right here, these two bumps right here. This one right here would be a potential double bottom, so that's on the 5 minute. We can scale that out to the hourly. Scale that out to the hourly. Drop this in right here, horizontal line. Zoom this in, put that right there. And potentially you have a double bottom idea, a reversal type idea. The other thing that you would look at is, and again, this is Ethereum to Bitcoin comparative. You would go to trend-based Fibonacci extension. You would go from swing high right here all the way down to swing low right there, and then back up to right here. So that would be right there, 30. Got it. Perfect. So it looks like we're just bouncing on support on this fib level, this golden fib level. Again, this is the inverse of the golden pocket, and this is absolutely monumental area right here. If we break through that area, that's not going to be good. And then if we find support on this area and bounce higher, that's going to be absolutely massively positive. And then again with this neckline right here, potentially for a double bottom type reversal situation. So we would draw another trend line right here. Boom. But yeah, this is the kind of information you want, because you need to know where to put your dollars. Because before it's like, oh, I can save my money, and now with inflation and, you know, into the beginning, and then after inflation is going to come negative interest rates. Either way, savers are now extreme losers. Let's see. So yeah, you're looking at potentially something like, you know, we really want to see where this breaks. If it breaks down, not good for ETH, and I'll probably pull my position. And then again, we have this double bottom type idea, and potentially if we get a nice bounce from here, which is what we were looking at before. Let me just thicken this line a little bit. So yeah, this area right here would be the measured move of that double bottom we were looking at yesterday, and this is a downtrend, and it does favor the downtrend. And this would be, you know, breaking this area and bouncing off this area would potentially start to reverse this downtrend idea. And then, you know, you have this other massive double bottom idea that's broken the neckline. So really there's a lot of macro factors that are pulling the price down, and we did get a pretty substantial bounce, and we're just looking to see, you know, is this an actual bounce, or is this a bounce just to, you know, essentially shake out some hands before moving down to our measured move. And this measured move right here could be, And again, you get measured move on the charts, but then you also have to factor in fundamentals. So that's why it makes more sense that it hits this level or support box and then bounces higher. But what we say is that we always have to factor in fundamentals of the graphs. So let me draw this right here. So, cost-based averaging in, I mean, you don't want your opinions to get the best of you. So even though Ethereum is undervalued, you can't ignore graphs. You have to factor in the technicals. And so these are just different levels that we're looking at, and this is absolutely massively gorgeous. And then obviously we want these areas to hold. And it looks like worst case scenario, if price action did come up here and bounce, oh my bullish. And would I have to pick up some ETH? I would just have to. So some more. I mean, we pretty much closed out our position. We had like a very extremely conservative, like 8 or something a little under 10K. I think it was like 8K that we just traded in profits. And I just have that little position open right now with ETH. But that's really what we're looking at. We can take a quick look real quick at altcoins. And then I'm going to be off for tonight. And then we'll just cover stuff again tomorrow. And then Bitcoin's mostly just consolidating, like what we talked about yesterday. And actually, if you guys remember the Ethereum channel that I was looking at yesterday. Oh, nice. Yeah. So this is looking really good. And yeah, alt season definitely in play. You're not going to see these charts anywhere else, but this is a Fibonacci channel on this downtrend, which has been extremely accurate, and it just went out of the golden pocket, which is absolutely massive. All right. I guess I have a little bit of time to show you that we actually did. I talk a lot about calling tops and bottoms, and my friends actually call me the money machine. Let's see, it's not this chart. Let's see, not this chart. Bybit. So let's see. So it looks like it just hit this area and then just wicked it really quick, and then there's looks to be some support from this overall bigger channel that we were talking about, where essentially you have these lines basically intersecting these trend lines. I don't know exactly, but you basically hit this measured move, wicked it a second, and then we were approaching this trend line right here, which we're still looking at right around. It's like right next to the price action. So you have, it's literally in between our measured move, and I don't remember it being this high. I think we deleted, pretty sure we deleted a trend line. I think I talked about that yesterday. But yeah, so that's what's going on with the price. And really like zooming out and looking at it like this gives you a really good understanding of what's going on with Ethereum. And especially because we covered the ETH to Bitcoin comparative, we went over alt season and Bitcoin's consolidating, so looks good.